Good evening, everybody, and welcome along to this webinar brought to you by ATFX in association with Trade with Precision. My name is Chloe. Thank you very much for the feedback already on the audio and video. Hopefully, you should all be able to hear it because some of you certainly can. So, as I said, my name's Chloe. Welcome along, everyone. It would be fantastic to hear from some of you. Let me know how long you've been trading. If you are beginners or more experienced traders, always good to know who is in the room. Feel free to drop questions in the questions box throughout. I will do my best to get to as many of the questions I can in the time that we have this evening. First of all, I would like to invite you to have a look through this disclaimer slide. I'll just give you a couple of moments to take a look through that, make sure that you agree with everything therein, and then we can progress through the presentation. Okay, so that should be long enough for you to have read through that. Just one more risk warning slide from Trade with Precision that I'd like you to take a look at. So have a quick read through that. I'll give you a couple of moments and then we can get on with the rest of the program. Okay, that should be long enough to have a look through all of those. So, as I said, welcome along, everyone. The agenda today, we're going to spend most of the session live in front of the charts. And we're going to have a look at the latest news of the various trade wars and how they're impacting the markets. I'll give a brief overview about the trade wars and what impact that is happening. And then we're going to just have a look at the charts and look for some potential trading opportunities, discuss what's going on in the market, and see if we can do a little bit of market analysis of what may be to come. So, bear with me while I just get my screen sorted. Hopefully you should be able to see that. Let me just get the platform up for you. Okay, so you should at least be able to see my platform. I'm using the ATFX MT4. So hopefully most of you will be familiar with this. Pretty standard platform that is really, really useful and functional. So if you haven't already become familiar with this, then I absolutely recommend you have a little bit of play around. It's fairly intuitive once you get to know it. The trade wars. Most of you will have heard about the trade wars. So it is mainly between the US and China. Obviously, other countries have started to weigh in as well. Yes, Mr. Donald Trump, don't we just love him? So, as I said, mainly started off between the US and China. US President Donald Trump complained about China's trading practices since before he even took office. So he has long complained about China's trading practices. And so the US launched an investigation into Chinese trade policies in 2017, and it then imposed tariffs on billions of dollars worth of Chinese products last year. And that obviously did not go down very well. So Beijing retaliated by imposing tariffs on US products. So this started off the trade wars. Both countries agreed to put a halt to adding new trade tariffs in December so that they could have talks with each other. But since then, the deal hasn't quite been struck, and there have been even more kind of tariffs, tit for tariffs imposed. So last year, the US imposed 3 rounds of tariffs on more than $250 billion worth of Chinese goods. And that was up to 25% over a wide range of products, all kinds of things, handbags, railway equipment, etc. And so China retaliated by imposing tariffs ranging from 5 to 25% on 110 billion worth of US products, and that includes chemicals, coal, medical equipment, all kinds of things there as well. So in 2018, Trump imposed $250 billion worth of tariffs, and he has still threatened to impose a further $325 billion of tariffs. And the total of the Chinese goods imported into the US in 2018 was 539 billion. So almost half of that has extremely high tariffs imposed. On the other hand, the Chinese tariffs imposed in 2018 were on 110 billion dollars worth of goods, and the total US goods imported into China in 2018 was 120 billion. So almost all of the US goods imported into China are subject to tariffs. So the truce that was agreed last December collapsed, and so in May this year, the US raised tariffs on a further 200 billion of Chinese products to 25% from 10%. And again, China then retaliated with tariffs on 60 billion of US goods. So it's very much back and forth, tit for tat, while they fail to come to any kind of agreement. So the US has since begun planning to hit an additional 300 billion of Chinese goods, but the G20 summit in Japan in June, Mr. Trump called that off, so that was just a threat, and he said he would continue to negotiate with Beijing for the time being, and of course, we all know what that means with Donald Trump. Any kind of change of heart could be imminent, of course. So why are these tariffs being imposed, for starters? Well, in theory, if the US imposes tariffs on Chinese goods, that in theory makes US-made products cheaper than imported ones, and it encourages consumers to then buy American goods rather than imported goods. So that is one reason for imposing tariffs, and of course they're just increasingly seen as a negotiation tactic in the trade war. So the impact of this so far, both US and international firms have said they're being harmed. That is stating the obvious, really. And fears about a further escalation are also having an impact on investors and hitting stock markets as well. And the IMF has warned that a full-blown trade war would weaken the global economy completely. So that is going to be a big problem. So going back to the basis of these trade wars, this is the world's 2 largest economies. So you can imagine how much of an impact that is going to have on not just US markets and Chinese markets, but globally as well. This is the world's 2 largest economies. So the whole thing creates really a lot of uncertainty for businesses, uncertainty for consumers, and is generally just hurting the world economy, full stop. So the US trade deficit has grown, and this is another reason that Trump has imposed these tariffs. So the US trade deficit, basically since 1985, for a long time now, has just been growing and growing and growing. So the US wants China to buy more US goods to rein in this trade deficit. The trade deficit is just the difference between how much the US imports from other countries versus how much it exports. And reducing that gap is a key part of Donald Trump's trade policies and has always been so. So imposing these tariffs is an attempt by him to increase the amount of goods that China buys versus the amount of goods that the US imports. So the most highly affected products, I mean, really it is extremely wide-ranging. As I mentioned before, everything from machinery to motorcycles, telecoms equipment, computer circuit board equipment, furniture, computer parts, metal and wooden furniture, floor coverings, car parts, all kinds of things are subject to this increase. So these are the things that the US imports from China facing the tariff increase. So China has accused Donald Trump and the US of starting the biggest trade war in economic history. And so therefore it has targeted US goods for additional tariffs, and those goods range from chemicals to vegetables and whiskey. It's strategically targeted products that can be purchased elsewhere. So, for example, soybeans. And this was one of the things that Trump has actually asked China to shift the tariff on soybeans to something else. And this is a very tactical move by Trump to basically he's trying to make himself look like he is doing something meaningful for US farmers, basically. So the US farmers have actually borne a huge brunt of the China retaliatory tariffs, and that has shown in US soybean shipments hitting 1-year low. So they're at the lowest point, or back in April they hit the lowest point in for the year. And so Trump has asked China to remove the tariffs from the soybeans and place them on something else, so that is seen to be a relief for the farming industry. And that is something that Trump wants to be seen as doing something good for farmers, because obviously coming up to the next presidential election, etc., etc. So they have been in discussions about moving the tariffs from the soybeans and farming products over to other things. So Boeing aircraft would be one of them, for example. So that's something that Trump has been battling with as well. So the impact on the markets has been very, very clear. So there's been a great source of uncertainty for financial markets over the last year, basically because of these trade wars, and that has contributed to a diminishing investor confidence. and we can see that in the indices. So let's have a look at the looking for the Chinese. Okay, so let's have a look at the monthly and the weekly time frame. So we saw basically for the whole of 2018 that was really very, very bearish. It went down, and it has recovered since December. It has recovered this year, but in comparison, if we have a look at the US indices, so this is the SPX 500, the S&P index, and we can see here that that is we can look at the Hong Kong as well. So we can see really a big fall, a big reduction in value across the entire index in of the Hong Kong 50, and we compare that to the US indices. It did see a fall at the end of this year, though last year, sorry. There definitely has been a large impact, but it has recovered pretty strongly. So in 2018, the Hang Seng, that's the Hong Kong index, it fell more than 13%, and the Shanghai composite slumped nearly 25%. So those are huge losses for 2018. They've both recovered some ground this year, so they're both back up so far in 2019. But if we compare that to, for example, the Dow Jones, that fell nearly 6% in 2018, and it's already up 11% this year. So the US markets have been a lot less affected by this than the Chinese markets have been. And of course, currencies as well. The Chinese yen fell over 5% against the US dollar last year, and this year so far it has broadly stabilized. So there's been another a knock-on effect on other countries as well, and the global economy. So there's been a significantly weakened global expansion, and the IMF has said that that is one factor. The US-China trade tension was one factor to have contributed to this, and contributed to the fact that it's cut its 2019 global growth forecast. And other countries that are indirectly impacted, other important trading partners for the US or China are indirectly impacted. And there's other trade battles that have been going on since Trump took office. So it's not exclusively locked to China. So Canada has imposed tariffs on 12.6 billion worth of US goods. Mexico, this is a big, becoming a big player as well. They've imposed tariffs of up to 25% on US steel, among other things. Again, a lot of farming products as well. The EU, another player weighing in, 25% tariffs on 2.8 billion worth of US goods. India, Turkey, lots of other players weighing in, and so the battle with China is just one of a series of trade fights that the US has waged with other countries over the past year. So really this is a more widespread issue, a more global issue than we might have initially thought. And certainly the US-China trade war has been at the forefront of everyone's mind, but it is having a much broader reaching impact. So the top 3 industries affected by the Oh, apologies. My apologies for that. Unfortunately, my answer machine automatically answers the phone, and then you have to wait for whoever it is to stop talking before you can get on with what you were doing. So my apologies for that interruption. So the industries, or the top 3 industries affected by the trade war with China, the tech industry has been massively hit for pretty obvious reasons. Automobiles, that has been massively hit as well. The tech industry and agriculture. So those are 3 industries that have been massively hit by the trade wars. And of course, in trading, we can take advantage of the knowledge of this. Now, at Trade with Precision, we are technical traders. So we are looking for, we don't speculate on the markets. We don't just say to ourselves, okay, these trade wars are meaning that the automobile industry is badly hit, and therefore I'm going to sell all of the stocks relating to automobiles. That's not the kind of trading that we do at Trade with Precision. But what we do is we're technical traders, and we will find technical setups and perhaps use the fundamental knowledge that we have in order to match that to a technical setup and give us an even greater confidence in our analysis. So if we find a technical setup that matches with the overall sentiment of the market in terms of what's going on with the trade wars, then that will just be an added tick in the box for that particular trade setup. So those are the 3 biggest industries that have been hit: the automobiles, the tech, and the agriculture industries. And within there are obviously some commodities and some stocks and some companies that will be the worst hit. And we don't really know if there is an end in sight to this, because we just obviously have no control over it. And at the moment, it doesn't particularly seem like the talks between Donald Trump and China are, it seems like 1 step forward, 2 steps back, or at least 2 steps forward and 1 step back in terms of the discussions that have been going on. So nothing is really certain. We don't know how long this dispute is going to rage on, and if there are new rounds of tariffs, then these industries could be again hit the hardest. So we would be wise to be aware of this. If we've already witnessed the highest points of tension, then there could be a little bit of a respite or a relief for these industries. But there is nothing really saying that that's going to be the case. And if President has taught us anything, it is that nothing is certain. So that's a little bit of background about the trade wars and the impact that it's having on the markets. Let's go back to the markets and have a look. So what we do know is that, there's one other thing that I need to come back to, and that's the effect on currencies. So I will come back to that for sure. But let's just have a look at the indices and see if and where we can spot any opportunities. Now I'm going to start with the US indices, because they are actually still performing very strongly. Now, the S&P index, even just today, has really taken off yet again. I remember back in, well, at the end of the year, I did a summary of the year for myself and was looking at the potential for a global recession to actually start, based on the fact that the majority of the global indices actually closed lower than where they opened for the year. And that is the first time that had happened. Let's look at the monthly time frame. You can see here, going back to 1996, there's very few times, and certainly for the last 10 years, going back to 2008, very few times where the markets have closed lower than they opened. And 2018 was one of those times. So this is the December 2018 bar here. Let me just excuse my terrible drawings, but that's the bar I'm looking at. That's December 2018. We can see that it closed down here. January 2018 was this bar here. So it opened here. So we can see that in 2018, we had the markets closing lower than they opened for that year. And that potentially could have a huge impact on markets, because overall investors lost money in 2018. However, what's actually happened is the markets have not only recovered, made back all of the losses that they made in 2018, but they have continued to rally. And we don't have any precedent here. So in terms of technical trading, what I would always be looking for would be levels of horizontal support and resistance. And we actually don't have any levels of horizontal resistance above us, because we've never been this high before. So for me, in order to find trading opportunities, I am looking for long opportunities. And I'm going to continue to do so until I find a technical reason otherwise. Usually I would have in mind an area or a zone where I might start easing off on my trading in a particular direction, because we may be approaching a level of support or resistance. But in this case, I actually don't have that limitation. So I am going to continue to look for long opportunities on the S&P index for as long as price action tells me to do so. Just looking at to make sure I'm not missing any questions. Yes, green close is top, red close is bottom. Let's go back to that. Yes, so the year closed down here and the year opened here. So we're looking at where the year opened versus where the year closed. So yes, green closes top, but I'm looking at where the year opened, which was the beginning of January, around there. So I am going to be looking for long opportunities on the S&P index until technically I see a reason not to. And in terms of technically seeing a reason not to, I would have to see a change in this price action. I've got bullish price action, I've got higher lows and higher highs. What I would need to see in order to change my outlook, I would need to see something like this: lower high and lower low. That gives me an indication that we could be in for a trend reversal. That actually didn't happen in this case. This was just a larger overall retracement or pullback, followed by trend actually returning. And so currently we have an uptrend. My moving averages are all pointing upwards also, and I am therefore going to be looking for long opportunities. Now, on the daily time frame, I need to wait for a pullback into my buy zone, I don't want to be entering a trade right up here because I've got no logical place to put my stop loss. And of course, stop loss placement is extremely essential to have your stop loss, and it's very important to have that in the correct place. So if I were to enter a trade up here, my stop loss would have to be at a technical level, and that for me would be all the way down here at this previous low. So that's not really an option. That would mean that my trade would have to move a long way just to get me to a one-to-one rewards to risk, for me to get 1 times my risk in profit. So instead, what I'm looking for is I'm looking for a best price to enter. So I'm actually looking for price to pull back and kind of breathe in, if you like. However far this extends up, I will be looking for price to come back down and then show me further bullish price action, and that's where I will be looking for an entry. So that will tend to be in this zone over here, this equilibrium zone. As you can see here, that was a really nice entry opportunity. Over here, when prices pulled back to this zone as well, we tend to see nice entry opportunities in those areas. So that's what I'm looking for on the S&P index on the daily time frame, is wherever price starts pulling back from. It could be from here, it could pull back already, or it could continue higher and then pull back. But I will be looking for price to be, first of all, in the zone of these moving averages, and second of all, I'll be looking for horizontal levels as well. So that level, for example, if I can get a bounce from that level, then that's going to be something that I'll be looking at as well. So let's have a look at a couple of the other indices. We have got the US 30, the Dow Jones, and we see the same pattern here. So what we see is really, really bullish price action ever since 2008. So we're going back 10 years. Answer to your question, Holly, those moving averages are, the black one is the 10, the blue one is the 20, the red one is the 50, and the green one is the 200. So we see a very similar pattern here on the Dow Jones. Very, very bullish price action. It all looked pretty much doom and gloom at the end of last year, but this year has recovered all the way back up to the highs. So the highs of around August last year, we have recovered back to those highs, and we are currently pushing up against those. So it's not quite so, it hasn't broken higher quite as much, but we definitely have a horizontal level of resistance here that we have now broken through. Today's price is trading through there. If it closes above this level, sorry, that's the weekly, so the weekly is above that level. The daily time frame closed above that level yesterday, and since then it has taken out these highs as well. So very bullish signals on the daily time frame here, very similar to the SPX 500. And again, I'm going to be looking for long opportunities. I've got no horizontal level in my way. The one thing I would say about this actually is, when we've got no precedent in terms of price action, I can't see a horizontal level above me in terms of price action, because price has never been this high. And when that happens, it's probably wise to look at round numbers. So for example, we do tend to see reactions at round numbers. So 27,500 could possibly be an area that price might react to, those kinds of levels. So that's really the only thing that we can go on. And as I say, it's not necessarily something that I would definitely say price is definitely going to turn around at that level, but it may just give you a guide if you were to be trading long, certainly on the lower time frames. So just briefly as well on the Nasdaq. Now the Nasdaq hasn't quite broken the highs as strongly. It has just about pushed up against these highs from back in April, but it hasn't quite broken through as strongly. Having said that, it is still in an uptrend, and I am still going to be looking for the same thing. I'm looking for, hopefully in due course, this level to break and then price to come back down and give me an entry opportunity when it comes back down to an equilibrium level. For all of these that I've mentioned, what I have said is I'm waiting on the daily time frame for a pullback. But what we can also do is we can look at lower time frames to see if we're any closer to a pullback. So for example here, this is a perfect example, hourly time frame on the S&P index. This is exactly the kind of thing that I'm looking for. Pullbacks to the moving averages, really nice opportunities for trade. So unfortunately, this is not a trade that we can get in, but this is a bullish bar. This is a bullish candlestick here, and it is in the buy zone of the moving averages. So that is a really nice opportunity to enter. What I would be looking for now is simply another retracement and another bullish candlestick in order to enter again. So I'm not going to enter right at the top here. I'm going to wait for a pullback and then I'll be looking to enter. So even though we're waiting for a bigger overall pullback on the daily time frame, if we're in a strong trend where we've got a higher time frame trend, and that is confirmed by several other time frames of trend in the same direction. So here we also have the 4-hourly time frame trending upwards. We have the hourly time frame trending upwards. So I'm looking at all of these time frames for potential long opportunities, and basically whichever one pulls back to my moving averages first and gives me a nice price action setup, that's the one that I will be looking out at. So you can see here, even on the 30-minute time frame, we have a couple of nice opportunities here. A little bit tricky there, but even if on the 30-minute time frame we were to be looking at this trend and waiting for a pullback into the moving averages and a bullish bar, we could have seen this bullish bar here, and if our stop loss was in the right place, we could have entered this trade and we would have sat through quite a few bars of nothing really happening, maybe even the trade being in negative territory. But if our stop loss was in a safe place, then we wouldn't have been stopped out of this trade, and eventually it would have taken off in the right direction. So even though in retrospect that does look like messy price action, it would have been possible to find an entry there, or alternatively simply wait for a break away from that messy price action, which happened here, then wait for a pullback, and then our bullish bar here, and there's our trade entry. So even if we didn't take this one, or even if we took that one and decided to close it because it wasn't going in the right direction quickly enough, there was another opportunity here, and certainly another opportunity here, and that is exactly what I'll be waiting for further down the line as well, if I don't see a retracement far enough to get me in on the daily time frame. But I'm looking at all of these time frames basically. Once I find a strongly trending market with nothing really in the way in terms of resistance, I'm very keen to trade that long for as long as I possibly can. So the same goes for all of these indices, all of these US indices certainly. Looking for long opportunities across all of the time frames, certainly down to the hourly time frame. I do sometimes trade lower than that, but I find the hourly time frame a really nice clean time frame to trade. Once we get down to the lower time frames, it can take a little bit more patience, is the only thing that I would say. And I wouldn't necessarily say, most people do call me a very patient person indeed, but I personally wouldn't say I'm that patient at all, and that's why I much prefer to trade on time frames that mean that I can take a look at I do my market analysis obviously at the beginning of the week. I make my watch list, and then I take a look at the markets at set times during the day, but then I don't sit in front of my screen all day. If there's a trade to place, I place it, and I place my targets and my stop losses accordingly, and then I walk away. I'm not patient enough to sit and babysit trades on a 5-minute time frame or anything like that. So yeah, I would just say the price action here on the hourly time frame seems to be really, really nice at the moment. So those are other time frames that I would be primarily focusing on. But again, it's a personal choice as well. So absolutely nothing against lower time frame trading. It can be extremely, extremely profitable. I would just say for me, most of the time I don't have the patience, or I'm busy doing something else. But can be extremely lucrative for those of you who have the right kind of personality for those lower time frames. So let's have a look. I did say I wanted to go back to the effect on currencies. So currencies are a lot harder to move than stocks, commodities, and even indices, because currencies are controlled by countries rather than by people or companies. But we have found that the trade tensions between the US and China are starting to pull foreign exchange markets into the picture, into the fighting ring, if you like. And that is because many countries are being forced to take a defensive posture against the dollar. The dollar is the real winner in all of this at the moment. Central banks seem to be really intent on keeping their currencies steady and stopping money from escaping, rather than engaging in devaluations to boost their economy's competitiveness in trade. So it's kind of counterintuitive. One might expect that because of the trade wars, countries would want to increase their economy's competitiveness and therefore devalue their currency. But that's actually not what's happening. Countries are really more intent on keeping their currencies steady. So policymakers in China, South Korea, Indonesia, very hard hit by all of this, and they have been taking steps to buoy up their currencies because of the prospect of more rapid depreciation and capital outflow. So that's what they're trying to avoid. So it is having an effect on currencies, and also the standoff in these trade wars is, I'm sure you've all heard of risk on, risk off. So the standoff is affecting investors, making them uneasy, and therefore they are very much risk off, which means that the tendency is to push investors or push investments into the US dollar, or into things like gold, which we'll take a look at in a moment actually, and have a look at the gold market as well. And so that in itself is a challenge, because if the dollar, the dollar is already near its highs for the year anyway. If it's seen as stopping efforts to promote higher inflation, then that is going to present US policymakers with a challenge as well. So the focus is on China, of course, and how China is going to handle the yen cheapening, because that is what is likely to happen. So the probability of the yen cheapening is very, very high, and the probability of the US dollar increasing in strength is also high. So the uncertainty in the markets continues. The trade wars just don't really show any sign of abating at all. And the most highly affected, or some of the most highly affected currencies, are the emerging market currencies. So, you know, Indonesia, South Korea, the Brazilian real. So the falling currencies could boost exports, but the central banks are suggesting that what they want is to stem the flight of investors. So it is something that is having a large effect on the emerging market currencies, especially. So let's now have a look, as I mentioned, at gold. Let me see if I can find that here. Perhaps I don't have it down there, so let's have a look up here. Okay, so gold, this is something that has really rallied in recent weeks. And in fact, in recent months, I mean, we could take it all the way back to August last year, which is really where that rally started. But we certainly have seen a very strong run to the upside since May, since mid-May. We have seen some really strong bullish price action on gold, but really since the end of last year, that this is the bottom for the year last year, and ever since then price has overall been trending to the upside. We did see this pullback here, but apart from that, we've really had price of gold just going up and up and up, and this is indicative of risk off mentality. So when investors are very cautious, they want to reduce the risk of their portfolios, they may tend to invest in things like gold, because it is really seen as a safe haven. So that we can definitely see the effect that has had on the market in terms of gold. Now with gold, I am looking for long opportunities, and really my next significant level of resistance that I'm looking at is around this level, about 1,500. So until price gets up to that level, I'm going to continue to look for long opportunities. Obviously, again, not wanting to trade when price is overextended at all, but again, looking for the same kind of things in gold as I was on the indices. So looking for pullbacks into the moving averages and bullish price action in order to get into a long position. Now, the one thing I would say is I'm always looking for small bars rather than large bars, and that is because I like to have a technically good place to put my stop loss, and I like that stop loss to be close enough to my entry that may give me a high reward to risk trade. But I'm also looking at getting in with the professionals, where the professional money is, not where the amateurs are getting in. And if we look at a market like this, gold has been rallying for a long time, certainly since end of May on this particular run to the upside. What's happening with the market is the professionals are seeing this pullback and they're getting in down here. So the professionals have taken profits up here, resulting in the pullback, and then they're getting back into the market. Up here, this is where the profit taking starts again. And we can see that here with the price action that has happened so far today, and we are nearing the end of the day. So for price to have put in this fairly bearish bar here, that suggests further profit taking. It is actually maybe not so clear for you to see, but the high of that bar there is around there, and the high, give or take my terrible drawing skills with my mouse, but those are pretty much the same highs. It might actually help if I just draw that in as a horizontal level. We've got pretty much the same high. In fact, this high at the moment is slightly lower, the high of today's bar. And if that closes as a bearish bar, then of course that's not where we want to be getting into the market. So if that's going to be the case, I would need to wait for further pullback before I can get long into gold. But it's certainly something that I have been trading long over the last few weeks, and in fact months overall. Just check the questions. Bearish trades, very good question. Now, not necessarily to do with Trump and the trade wars, actually. Let's have a look at the euro dollar first of all, and then I will come back to that mention of bearish trades. So euro dollar, it's not so easy to see a picture of how this has been affected by the trade wars, because we don't have such a strong trend in any one direction on the euro. It's actually been fairly choppy lately, but at the moment we do actually have, well, we had this downtrend here, and that has changed. We've had this higher low. We've also had a higher high. So really this is one that I'm on the fence about, euro dollar, because I don't want to trade long into any resistance, and that 200 moving average for me is potential resistance. What I will be looking out for is if price gets above that level, I will be looking to trade long from that point onwards. But equally, I don't particularly want to trade short while I have an uptrend, which is higher highs and higher lows. So for me, the euro dollar, I don't necessarily see any good opportunities at the moment. But back to your question about bearish trades, not necessarily related to Trump and his trade wars, but cable and anything really as a cross with the pound at the moment has been a pretty safe bet for short for quite some time now. We have got the leader of the Conservative Party battle going on currently. So it's between Boris and the other guy, Jeremy. And that is having an impact on the markets in the UK and an impact on the pound. And of course, that's at the forefront of everyone's mind right now. But as soon as that leadership battle has been won by whichever one, whether it's Boris or Jeremy Hunt, we're going to be back to Brexit talks, and that is going to come back into the forefront of everyone's mind. So there are a few obvious reasons, therefore, why the pound and pound crosses are depreciated. The pound is depreciating. So cable, certainly we can see bearish price action there. So again, going down to the lower time frames, looking for pullbacks into the moving averages, and then looking for short opportunities. And we can see here, even just with the pound, we've got pullbacks into the moving averages here, 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 here. That is definitely not an opportunity I would have traded because that bar is far too large. But we've got another pullback here, here. Again, this one here, bar is a little bit too large, but I'll be looking closely around here potentially as well. There are, of course, other pound crosses that are potentially better options for trading short. Pound Aussie has been really, really nice because while cable is in a little bit of a range here on the daily time frame, and we also have some other, so for example, pound CAD. Pound CAD has been going down for quite some time now. This is this move to the downside started pretty near to the beginning of June. So that is sorry, near to the beginning of May. My apologies, near to the beginning of May. So that's 2 months of selling price action. So yes, I am still looking for short opportunities. I'm not ignoring any opportunities, but I'm very aware that at some point this is going to have to turn around and revert back to its average. So at some point that run is going to end. Whereas with pound Aussie, that run to the downside really has only just started. We do have a move down here, but we've had a recovery of that. So this next move here, it started relatively recently, and we could potentially have a lot more to go to the downside on that one. So pound Aussie around this level was definitely something that I was strongly looking at, and it still is something that I am strongly looking at. Pound Kiwi, pretty similar as well. That's another one to look for potential bearish opportunities on. Pound Swiss is another one that has been going for quite some time, so I'm not so convinced, and pound yen as well. We haven't seen a very significant pullback on those yet, so that's really what I'm looking out for. And dollar CAD as well as another bearish one, which we have, we've just started that downtrend. Really, that was the start of the move to the downside up there. And ideally, what I'm looking for here is a pullback into the moving averages, and then I'll be looking for another short opportunity there. So let me just take you back to the presentation very briefly. Okay. So we'll just finish off with a little bit about ATFX. Why choose ATFX? Well, they were the winner of the Online Personal Wealth Awards 2018. They're regulated by the FCA, the Financial Conduct Authority. They have an efficient, secure, easy-to-use payment portal. They are committed to providing competitive prices for their clients. They use MT4, which is investors' most widely used trading platform. That is what we have spent the majority of the evening looking through. So that is a really nice platform to use. And of course, they have a fantastic customer service team, bespoke customer service and trade support for all client trading needs, 24 hours a day, 5 days a week. So these are the contact details that you need if you wish to open a live account. There's a postal address up there, phone number, free phone number within the UK, or a phone number from outside of the UK as well. And that is available Monday to Friday, 9 AM to 5 PM UK time. And of course, you can contact the sales team and the customer service team at those email addresses down at the bottom there. So I do encourage you to use those. They've got a fantastic customer support team. So thank you very much for being with me this evening. It has been a pleasure, and I do hope to speak to you all at another one of these presentations in the not too distant future. Cheers everyone, have a fantastic evening.